Matt Davio, back with Darrin Newsom. Darrin, I didn't ask you, but are you still in Omaha?
I am based out of Omaha these days.
Okay, so Darrin is a senior analyst, originally writing about agricultural trades and products for DTN. DTN was purchased by Telvent, which is as I understand, again, Darrin was educating me a little bit, a Spanish media company that wanted to get more into some diversified products, and obviously DTN being a agricultural media entity itself, which Darrin is an analyst for. So I appreciate you coming on today, Darrin.
Well, thanks for having me on, Matt.
So give us a little background. Why would a Spanish media company want to buy an American-based grain and agricultural media entity?
Well, Telvent is, a very large IT company over in Spain. They do a lot of the backroom, bookkeeping and setting up for programs for transportation, in Spain, energy programs in Spain. And so what they were looking for was, an avenue into the U.S. market. And DTN has a very large refined fuels program. We also have energy. We have, our own IT, being a computerized electronic media company ourselves, we have a very large customer base for this electronic media sort of thing. It was a very attractive fit for them. It was a way for them to take their IT business and really start to grow. Plus, it was able to take DTN's core business of energies and ag, and information and put it on a larger international scale. So opening it up to a larger clientele. So it's worked very well for both.
Yeah, and again, as I said before we came on air, I mean, to me, the ags, I'm not alone. Obviously, very smart people, much smarter than I will ever be. Jim Rogers, et cetera, say that farmers will be the next generation's bankers. What do you think of that statement? That Jim likes to get a rise out of people, of course, but what do you think of people saying things like that?
Well, we go back to 2005 when these markets changed their nature, where rules were changed, by the agencies and the exchanges to allow larger trade. All of a sudden, a very bright spotlight was shown on the ag markets, particularly at the same time with corn moving into a demand-driven market. Now, all of a sudden, it is up on it's one of the upper echelon markets. It's up there with crude oil and gold as far as the leaders of the commodity sector. So, I think this is going to continue until we see a time when global demand for these products start to come down, for these food products and other ag markets start to come down. I think this is going to continue. I think it's going to be a major player, not just on the supply and demand scene, not just on the commercial grain scene, but in the investment scene as well. It has become an investment tool, and ags have played a major role in that. And again, supplanting some of the more traditional investment opportunities that we've usually seen in commodities, gold, crude oil, and so on.
Now, interesting. Give me a little background. Give our viewers a little bit of background, because you're not just a straight, writer, publisher. You are more of an analyst. You've worked as a trader. You've worked as a broker. You've worked as a money manager. So, kind of give us a little flavor, of your background and why you say the things that you said, because this is really, as I said, I think a precipitous moment in time where. I think the trend is really, I agree with you, by the way. I think we're just beginning to kind of take off, and I'll get into some of the questions on why we're taking off. But give us a little background, if you don't mind, on why you think some of these things are true.
All right. It all started basically back when in the crash in 1987, stock market crash of 1987. Drew my interest. I had my account opened up at that point and was starting to trade, things like S&P and some of the grain contracts at that time. But what was most interesting to me is why things were doing what they were doing. We didn't always follow news items, or we didn't always follow whatever the latest piece of supply and demand information was out there. So, as I worked through this and worked to becoming a broker at that time, what interested me was what drives the market. And so I started off by just looking at charts and became more of a technical analyst. But through the years, I was able to throw out most of the technical signals, most of the technical indicators that are used basically as mere noise. And I started winnowing down what was most important in these markets. Number one is always trend, and so then so what's driving trend? Well, through the years, it's always been money, but now we're just talking about different levels of money coming in and out of these markets. So as I progressed from the broker to, say, a grain merchandiser to a consultant, never quite reaching the stage where I was going to be a money manager. I had that opportunity, but kind of backed away from it to pursue other avenues, particularly this one here at DTN as a senior analyst. We just kept putting the picture together as to what makes these markets work, how they're all interrelated, and that's what I still find interesting. That's what I write about. That's what I look for, is how these markets are moving together. And what we can see, anyone can take a look at the markets, see the prices, how they line up, and tell what's going on in these markets. That's what I find fascinating.
Yeah, so again, as I intimated to you, I'm more of a chart guy generally as a trader. I find charts to be probably the most accurate, especially, it doesn't matter to me what the time frame is, whether it's an intraday or a year chart. You just have to trade accordingly based on where the chart is. I think where people get in trouble with charts is they style drift, or they use the short-term chart to make a long-term decision, or vice versa. But the thing that's always fascinating, and you really brought it up well, price is the only thing that matter. Trends are the only thing that matter. And technicals really just are a derivative of that price. So with that being said, and again, myself wanting to learn more about the fundamentals, obviously weather, the cycles are important when it comes to grains, but those are pretty well known, and then those cycles are pretty ebb and flow. I think you would agree. So everybody knows those kind of taught things, but the things that are changing now, Darren, and you said it, is the way the markets are behaving and the participants. You've got so many big, new big money coming into these markets that maybe aren't looking at the markets the traditional way. So how does that change the way that you view the markets, and how do you think that changes the way the markets behave and participate?
Well, you raise a couple of great issues. Number one, how these things have changed. Grains and most commodities as a whole have seasonal cycles, and those seasonal cycles tend to reflect the ebb and flow of supply and demand into the market. At harvest time in the grains, you used to see normal lows. At planting season, when there wasn't a lot of grain moving, that was when we would see the markets rallying. Those types of cycles have changed. They are not as clear-cut as they used to be, and that has to do more with when money is coming into the market, coming in and leaving the market, rather than the supply and demand changes. It's still there. It's just not to the same degree. A few years ago, I had the opportunity to speak to a group of hedge fund traders in New York, and the whole time I was there, I was not once asked about supply and demand. What they wanted to know about was volatility. What they were basically looking at was reading and rating volatility to be able to determine how many contracts in a certain market to get into, how heavy to load up one or the other. And so I think that's still a key, is looking for markets that have reduced volatility. As far as changes since 2005, these markets don't necessarily behave like commodity markets of old. Back when a long-term trade might have been 2 or 3 days up to a couple of weeks. Now we see long-term investment money in these, and so we have longer-lasting trends. A change in trend is important. One of the key aspects of my analysis is using Newton's first law, and a trend in the market will stay in that trend until acted upon by an outside force, with that outside force being investment money. So we watch it longer, and we ride these moves longer, using the filter still of fundamentals, but fundamentals in a different way, and that is trends in the future spreads. And I think that's how we can better judge these markets.
Yeah, you see, I mean, it's wild, some of the moves you've seen in these markets, and I'd like to just ask you specifically, just to bring up some examples, but, the cotton market, had a huge move earlier this year. The cocoa market, I think it was spring of 10, was huge. The coffee market, went parabolic here, and now they've all kind of reversed. And so, with these moves, and again, because of the money that's chasing in different vehicles, do you think a lot of it is because of these hedge funds and these, our ETFs driving this and affecting the price exaggerations? I don't know if they're never exaggerations if that's what the price is, but.
That's an interesting question, and my viewpoint on it's not very popular, and there's all kinds of data floating around that supposedly disproves it. But yes, I do think the types of move we see is largely due to the increased interest we see from the long-term money. Those markets that you mentioned, they all started off as relatively quiet or relatively low volatility markets that attracted money coming in. Then you may have some headlines, not necessarily actual fundamentals, but you have some headlines that come in that feed the machines then that decide on their algorithms whether to buy or sell, push these markets higher. Yeah. Then when that dies out, the market volatility explodes. You can't keep pushing money in, so money comes out, looks for the next low volatility market. Right. So we shift back and forth, I believe, due in large part to volatility.
Well, that's a fascinating subject because I tend to agree with you. It's almost like, okay, we can push this market up or down, so let's get into it. I mean, you saw it, like I said, you mentioned it. These markets haven't typically moved this exaggerated in such a short time. I mean, cotton, there was no fundamental thing. There was no fundamental thing about cocoa. It was clearly money chasing these futures markets and big money and driving them up and riding that trend. As you said, the trend was very, very visual. You could see it in the charts. You saw it in coffee. That's the most recent one to me that was just amazing. Coffee went up to 308 or so, I think, and now it's back down to 240 today. And it's amazing, and that's in less than 3 months. We went shot all the way up there. Now we're shooting all the way down. And I'm talking to the local coffee shops. They're like, "What am I going to do? And I'm a roaster. How am I going to manage?" These guys, they're retail guys. They don't even know. They've never seen anything like this. So it's affecting the businesses. And then in the last couple of weeks, this is 3 months after coffee peaked. You see the ETF JVA go parabolic through the roof. And it has nothing to do, again, with the actual physical. You watch the KC itself, and it's way down. So, I mean, it's confusing.
It is, and an interesting thing that I've noticed or that I've watched over time is, how do these markets react when we see the fundamentals either line up or diverge from the general investment opinion? And what I mean by that is, let's take the difference between cotton and coffee. In the cotton market, we didn't have extremely bullish supply and demand, but we did have bullish supply and demand, and the futures market was in backwardation. If we looked at the future spreads forward curve, it was in backwardation, meaning the commercial side knew that the underlying fundamentals were tight. And so that gave the rally in cotton that much more strength. You contrast that with coffee, where we've been in a contango situation, throughout this rally. That means that we've got this divergence. It's like a rubber band stretching. It can't hold. It's going to come back at some point. The futures will come back because it doesn't have the support of supply and demand. Just as you said, once the volatility runs its course, traders are going to get out and we're going to go elsewhere. So that is one thing that I look for in a market, not only just low volatility, but then rating these markets on, is it in contango, is it in backwardation, which one has supply and demand that could provide support to this rally, and that's what gives it the extra strength and staying power.
Right. And that's where, again, the fundamentals start playing a bigger factor, I'm sure, for, the strategies that you're really talking about longer term. It's like, okay, the volatility and there's money in it, but maybe now there's some support at some lower levels. Now may be a time for you to, get involved in this soft, coffee market or, the soft cotton market now that it's gone from 240 down to 90. I mean, just some crazy moves. Obviously, we were chatting a little bit, by the way, if you don't know, folks, you can follow Darin on Twitter also at Darin Newsom, and you've got your name spelled wrong here, but it's D-A-R-R, and I'll post it on the little write-up before I do it, but you can follow Darin Newsom at Darin Newsom, on the Twitter feed also, which is where, the news is happening. And, I just got to ask you, what do you think about social media and what's happening out there and the way that is also changing and driving markets?
Initially I was kind of skeptical about Twitter, but the more I got into it, I find it a very useful tool. I can set up who I'm following. I can get all kinds of information coming off the floor from other traders such as yourself. What other people are seeing in these markets. And again, it's not just the normal noise that comes with news and headlines and these sorts of things, but it's people who are actually in the trenches, having good questions, good comments for the most part. And, you carry on conversations. I think it's a great way of expanding these markets, expanding our knowledge of these markets, see what other people are talking about, what they're looking at, because that's what makes up these things. I mean, it's not just one set of indicators or one set of factors that drive these things. It's the combination of all of them. And then so to get a better feel of that, I think Twitter's allowed us to do that. And so I do find it a very useful tool.
Yeah, it is a very powerful tool. Today, I'll give the date here. It's Friday, July 22nd. We had, again, Twitter continues to beat traditional media, I've got to say, as far as breaking news is done. I've said this for years. Breaking news happens. You can't break a story anymore because of the internet, and Twitter is really the vehicle now where, the Oslo bombings, 10, 15 minutes before even a Bloomberg terminal was flashing that. I was seeing it on Twitter. So very powerful tools, like you said, for traders, and markets are all driven by people. Mm-hmm. Whether there's algos behind those decisions or not, it still comes down to the market is made of people, and the faster that information flows, it is an amazing tool. And again, it really does shrink the world and the way that markets behave by having this information at our fingertips, and it's fascinating. When it comes, let's circle back to the ags, and we were talking about this again on Twitter this morning. The dollar, more than ever, even more than oil, and I said this also yesterday, probably is more powerful today even than oil is when it comes to grain prices. Would you agree?
I would. I think there's a very strong negative correlation between the dollar and the grains. Not necessarily over the last couple of months, some weather items playing a role, but in the long run, I do see that relationship has tightened up a great deal.
Mm-hmm. So, how does that's a new paradigm for right now. It may not last forever, but the dollar is driving all markets, whether it's currencies down to oil, to the grains, to equities. I tell people that are traditional equities guys, momentum is not being driven by anything fundamentally in equities right now, and that's the case at many times, and it really is the dollar right now that's driving every asset class.
It certainly seems to be. And again, there's always been this tie between all these markets, from bonds and dollar and stock markets and commodities. But that has changed. Now, we can tie all of what we've talked about, together. The information, the availability of information, the speed of the information, news that is affecting the dollar, overseas global events, as you mentioned, the Oslo situation, all of these things, and with the dollar being one of the key global markets, that, and some would say gold as well. I question that a bit, but putting gold into that classification as well. Then everything starts to focus on the dollar. Okay, so now how do we need to relate to that? How do we need to move in relation to the dollar? Does this affect our commodities? For so many days now, what we've seen is gold and the U.S. dollar index rallying together. Not something that normally happens, but what it certainly indicates is the problems going on over in Europe. So we can start to build just by looking at how some of these markets are moving together, again, in relation to the dollar. We can start to put together what may be going on and what may be being traded at the time.
Yeah, and it changes very quickly also, Darren. That's the thing that I think, because of all these fascinating new pieces of market delivery mechanisms, from Twitter to, whatever the new thing may be, it really, markets are always dynamic, but they're changing so fast now. It's by the time you've gotten a lesson, it's already moved on to the next four.
That's right.
So how do you deal with that as an analyst? Because it is very, it's not easy.
No, it's not. You have to take the long-term view of it. You have to realize the money that's at play now is not the traditional commodity funds, which were more short-term in nature. We have a much larger long-term money, and so we have to take a long-term view of these markets. We're going to see wild intraday swings. It's not unusual for corn to say trade limit up one day, 2 days later it's limit down, or soybeans or cotton or whatever the case might be. But what we have to do is we have to take a long-term view. What's the long-term spreads telling us about the market's view of fundamentals? What's the long-term outlook for the dollar? What are futures? What are Fed fund futures saying about the possibility of an interest rate increase, which kind of acts as the backbone fundamentals of the dollar? And then that allows us to filter then these short-term news items where, okay, we may be getting a lot of choppy up and down move in the market, but it doesn't change the long-term picture. And I think that's what's key is this long-term view that we've had to take in commodities, something that really by nature isn't commodities forte, but it's certainly something that's evolved here over the last number of years.
So as an Omaha-based analyst, have you ever farmed?
Yes, grew up on a farm down in south central Kansas.
Okay, and what did you farm? What kind of things?
Growing up, it was mostly wheat and milo/grain sort, and then it was starting to move towards irrigated corn and soybeans. About the time I really started getting interested in these things, I went a different direction, got off the farm again, went towards the market side of things. But yes, still go back there every once in a while. But it was at some point or other we have most of the grain crops.
How's I'm sure you talk to farmers regularly for the work that you do and the writing that you do. How has the farmer changed? What does his profile look like today versus 20 years ago?
Generally, much larger than they were 20 years ago. Also, they hold much. Their risk is greater, obviously. They are much more aware of moves in the market. I mean, the other day I was talking to somebody who had a $1.60 move over the span of something like 4 days in the corn market, and that's total net and down and up. Adding it all together was $1.60. That was a year or two's worth of range way back when. So I mean, the volatility that's there, the way they have to follow information. Many of them now have their computers, their tablets, their computer tablets, whatever, with them all the time. Their iPhones, their smartphones, whatever it might be. They have that connection to the markets these days because things can change so quickly. There's so much information out there now. Things can change very quickly, and they have to be able to adapt. The types of risk management that they have to do, also much different than it used to be because, again, of the volatility and the very character of the commodities themselves. Maybe looking more at option strategies, but high volatility kind of disrupts that a bit. More cash contracting, so the relationship between cash and futures market has to be understood. It has changed over time. It's a much different market now. It's much more professional than just, and I don't mean that in any disrespect to the farmers of old, not that they weren't professional, but a more business-like approach to it, a very high volatility business-like approach to it.
So, like you said, in a week, $1.60 move in corn. So does that, I mean, they're obviously looking at the prices daily, but they, like you said, you don't see a move that wide in a year over their 20 years of doing this. So how does that change the way that they operate? I mean, do they become more active then in the markets? Does that force them to have to participate in the open markets more or not? Or are they just like, gosh, I wish I could lock in that price, so I will. I think, I want to get this price. I'm just curious what their mindset is.
Well, in some ways, it's actually forced them out of the market a bit. The higher volatility makes it more difficult to do traditional market. Straight hedging anymore is very difficult. I mean, if you're a smaller farmer who might want to do, let's say you raise 50,000 bushels of whatever crop, and you want to do 10% of it. You're talking about one contract, so you put it in, and before you know it, you may have $2 worth of margin calls, and for many people, that's just unsustainable.
Right.
So it changes the tools that are available. It takes away from some straight hedging. On the other hand, if you're too large and you're talking about 20% maybe being 50 to 100,000 bushels that you have to hedge, there's just simply no way you can do it. Yeah. So it does force you to look at many of these hybrid type of contracts that have come out, the cash contracts that act all different kinds of ways. Some are looking at OTC markets.
Right.
Again, they're looking at option markets, but high volatility does hurt that type of business. There's different avenues now that they're having to follow, and basically what we see, like we saw it in 2008, we've seen it again in 2010 and 11, basically drifting away from just using straight futures contracts and looking into these other types of risk management.
Well, I mean, there is no disrespect, because if I were in their shoes, and basically, like you said, the volatility would scare the dickens out of me if I'm used to a move that's seen in a week that I haven't seen in a year. It would be scary. I would be thinking, well, if I get this price, I make this much profit, but if I didn't lock it in, it could go even higher, and I'm leaving all that money on the table. I could see why it would scare people away. Does that concern you? As far as is it just going to make the farmer bigger and bigger? More big ag.
I think we are moving towards more and more big ag. Does it scare me? It just adds another layer to what we have to do. If we're sitting there and we're in our pro level system or service that we offer by subscription to our customers, if we're sitting there, we're going to say, okay, you need to do a certain amount of your crop at these price levels. We have to understand that we can't just go out and say, hedge the futures market. We have to understand they're going to be looking more at their local cash markets. They're going to be looking at the relationship between the cash and futures. Is it broken? Is it moving together? What are these things that we can do for them? We do have to approach it differently. These aren't the same markets that we had back when I was merchandising and so on. So they have to handle it differently. We have to handle it differently. And it's not that I like it or don't like it. Seeing the news this week that the CME is really thinking heavily about increasing the corn price limits. It's all just new things that we're going to have to deal with, and we're going to have to adjust our analysis and recommendations accordingly.
Obviously, volumes are growing on all these different types of contracts, whether they're straight futures, OTC, it doesn't matter. Liquidity, 24/7 markets, is it coming?
We're almost there now, as you well know, Matt. I mean, we've got the CME Globex sessions that are very, they're getting more and more active all the time. And those hours have been extended. So I just think it is a matter of time until we're close to 24 hours a day, 7 days a week. Computerized trade is really dominant right now. There's not a lot of pit trade that goes on in most markets. And around the world, people consider computers and trade these markets, and with ag markets being so important and in gaining on their importance every day, it seems. Can we see 24 hours a day? Sure. Yeah. I don't think it's that far off.
Yeah, well, I think it's got to be. I think it's got to be that way for the same reasons. We all have to eat, and more people around the world are eating these products than ever. And that's only going to increase as the liquidity increases. So I'll leave you with one final question, and I'd love to have you back on, by the way. And that is, give us one big trend that you think people need to be watching that's just starting, that you're kind of keeping your finger tapped into right now.
I think the biggest thing that I saw, and it came in June, was that the corn market posted a similar bearish signal that it did back in 1995-96 when that supply-driven market came to an end, and in 2008 when the initial run-up in commodities came to an end. It seems counterintuitive with all we've just talked about, with the weather problems that we're focusing on, that we could see the corn market move into a downtrend. But if we combine that with the last month's move or this month's move to a new 4-month high in the U.S. dollar index, trying to hint that it may start to gain strength, there is the possibility that the corn market could come down despite all of the fundamental reasons. And I think that's going to be key to watch. It may not happen, but I think that's going to be the most important market that I'm going to be keeping an eye on in the near future.
Well, I like that idea because I tend to agree with it more on, I've kind of said the same thing, and I think if you're right and I'm right, I think the same thing is kind of shaping up right now, which is opposite of what most people are thinking, but I think that'll play out in ags and in oil, as I think the dollar needs to rally here. Not that it's going to be long-term or forever and ever. I think the dollar is looking doomed right now the way policies are there, but that being said, we are traders and we have to look at these interim trends, and right now it is shaping up. To me, I agree with you. The dollar looks higher, grains look lower, and I think in that sense, the corn oil combination there even gives more power to my thesis, and I like that idea. I like that idea.
Right. Well, very good.
All right. Well, Darrin Newsom, again, from DTN, the Progressive Farmer. I'll link it here on the bottom of the interview. I appreciate you coming on, Darrin. This is fascinating, and I'd love to have you back on and get into some more detail on spreads and what that means to all of us lowly traders out there as the world market in trading ags grows and grows. I appreciate your time.
Well, I really enjoyed being on, and thanks for having me on, Matt.
Okay. Thanks.